In intelligence work, the most dangerous threat is never the one screaming for attention. It's not the missile launch on radar, not the headline flashing red across your screen. The real threat is the one moving quietly, deliberately. While everyone else is distracted, it blends into the background. It waits. And right now, not last year, not someday, right now. That's exactly what's happening in the silver market. Traders are trained to chase noise. They hunt explosive green candles, panic crashes, volatility that feels alive. But pull up the silver chart in the low $60s and you'll see something that should make you uncomfortable. Nothing is happening. No breakout, no collapse, no excitement, just a flat, lifeless price, grinding sideways day after day, refusing to move. To most people, that looks like failure. It looks like a rally that ran out of steam. It looks boring, and that's the trap. Because while price is frozen, volume is exploding. Billions of dollars are changing hands right now, silently, aggressively, without pushing the market an inch. That doesn't happen in a free market by accident. That only happens when something massive is standing in the way, absorbing everything being thrown at it. When price goes nowhere and volume goes vertical, it means someone doesn't want you to see what's happening yet. And by the time the chart wakes up, the window is already closed. To the casual eye, silver looks worn out, like a runner who sprinted too early and ran out of air. After a powerful move up, the price stalls in the low $60s and just sits there, day after day. To most traders, that reads as weakness, a rally that failed, money already made, time to move on. That surface level read is exactly what gets people on the wrong side of history. Because price, by itself, is a terrible witness. Price shows you the outcome, not the fight. To understand what's actually happening, you have to look underneath the candles, into the flow of orders, into the volume that most people scroll past. And when you do, the story flips completely. Over the last several sessions, billions of dollars in paper silver have been dumped into the market. Banks have leaned on the sell button. Algorithms have fired relentlessly. Shorts have pressed their advantage, expecting the usual response, a breakdown. Panic, stops getting hit, price cascading lower like it always has in the past. But this time, it didn't happen. The price didn't collapse. It didn't even bounce. It just stopped, like a car slamming all into an invisible wall. Every push lower was absorbed. Every sell order vanished the moment it hit the book. That kind of behavior is rare, and it's never random. Markets don't just decide to hold a level under that kind of pressure. Something has to be standing there, taking the other side of every trade, calmly, endlessly, without emotion. Think about the mechanics. In a normal market, heavy selling creates air pockets. Liquidity dries up, bids pull, and price drops fast. But here, liquidity is infinite at the same price. Sellers show up, confident, they hit the bid. And the bid refills again and again and again. That's not strength from retail traders. That's not momentum funds. That's not banks defending a position they're nervous about. That's patience. That's planning. That's someone who already decided the price and doesn't care how long it takes. This is how real accumulation looks. Not the flashy kind that makes headlines, but the quiet kind that rewires ownership of an entire market. Weak hands sell because nothing is happening. Strong hands buy because nothing is happening. Every minute the price stays flat. More silver moves from people who want liquidity to someone who wants control. Cause becomes effect. Effect becomes escalation. The longer this goes on, the more unstable the structure above it becomes. That's the perception reversal most people miss. Boring isn't bearish here. Boring is a signal. It's the sound of something massive feeding beneath the surface, unseen, unbothered, and completely unconcerned with what the crowd thinks. When a market absorbs this much pressure without moving, it's not asleep. It's being held. And when that grip finally lets go, the move won't ask for permission. If you or I want silver, the process is simple. You open a brokerage app, hit market buy, and the price nudges higher. One click, one reaction, but scale changes everything. When the order isn't a few $1,000s, but $650 million, the rules flip completely. Try to buy that much silver the normal way and you don't just move the price. You blow it apart. Liquidity vanishes. Sellers pull their offers, and the chart gaps straight through your own order. You end up paying $80, $90, maybe $100, all because you showed your hand. That's why institutions never buy the way people do. They don't announce themselves, they don't rush, they don't chase, they move like shadows. What we're watching in silver right now follows a very old institutional playbook, one that's been used in currencies, bonds, and commodities whenever someone needs size without attention. The tool is called an iceberg order, and it's designed to lie to the market. On the surface, the order book looks harmless. 5 contracts sitting on the bid, nothing special, but that visible order is just the tip. Underneath it sits a massive hidden position, tens of thousands of contracts waiting in the dark. A seller comes in, hits the 5 contracts, and thinks they cleared the level. But the moment those contracts are filled, the algorithm reloads them instantly. Same price, same size, no hesitation. Sell 5, reload 5, over and over. To the seller, it feels like infinite demand. To the chart, it looks like nothing is happening. This is exactly the pattern silver has been tracing. Hour after hour, session after session, the price stays pinned in the low $60s while volume spins like a turbine. Sellers throw everything they have at the market. Banks lean on it. Algorithms press it. Shorts expect the floor to give way like it always has before. But it doesn't. Every push lower gets swallowed, not bounced, absorbed. That distinction matters. A bounce is emotion, absorption is intention. Based purely on volume turnover over the last few days. The math points to a single entity quietly taking 10 to 15 million ounces off the market. That's $650 million to as much as $1 billion in silver, acquired without triggering price discovery. No spike, no headline, no panic, just ownership changing hands, piece by piece, like a tide pulling water out to sea without anyone noticing until it's gone. This is where cause turns into consequence. The longer this iceberg stays in place, the more sellers exhaust themselves. Weak hands sell because the price won't move. Strong hands buy because the price won't move. Liquidity drains upward, invisibly. And once the selling pressure finally runs dry, the mechanism flips. The hidden order doesn't need to defend the level anymore. It simply steps away. When that happens, the market doesn't ease higher, it gaps. Because the floor that held everything together was never natural supply and demand, it was a wall. And walls, once removed, don't fail slowly. What you're watching in this flat range isn't confusion, and it isn't exhaustion. It's a transfer, a quiet, methodical changing of ownership that only happens at the early stages of something much bigger. The people who bought silver around $50 were looking for speed. They expected momentum, headlines, a fast move they could brag about. Instead, they got silence. Every small dip feels like danger. Every stalled day feels like failure. And under that psychological pressure, they do the only thing they know how to do. They sell. On the other side of those sales is a very different mindset. These buyers aren't watching 5-minute charts. They aren't measuring profit in weeks. They're measuring outcomes in years. They don't need excitement. In fact, boredom is exactly what they want. Flat price means supply without competition. Every nervous exit becomes their entry. This is how strong hands are built, not in breakouts, but in stretches where nothing seems to happen and everyone assumes the story is over. We've seen this movie before. In prior silver rallies, the price went vertical fast and collapsed just as quickly. Why? Because those moves were driven by paper speculation, futures contracts, leverage, momentum chasing momentum. When sentiment rolled over, there was no real demand underneath to hold the structure together, so price fell through its own shadow. That's why those rallies felt dramatic but never lasted. They were built on air. This time is different, and the difference is subtle but decisive. Sentiment is gone. The hype has drained out. No one is celebrating silver right now, and yet, despite that emotional vacuum, the price refuses to fall. That's the signal. That's how you know something structural has changed. Demand isn't showing up because traders feel optimistic. It's showing up because someone needs the metal regardless of mood. Headlines, because or macro narratives. This is the hidden mechanism most people miss. Markets don't move just because prices change. They move because ownership changes. Weak hands need constant reinforcement. They need price to validate them. Strong hands don't. They validate themselves through time and necessity. Every hour silver stays pinned, more supply migrates from people who want liquidity to entities that want certainty. The cause is boredom. The effect is consolidation. The escalation comes later, when there's no one left willing to sell. Think of it like pouring concrete. You don't build a skyscraper on wet sand. You let the base settle, harden, cure. From the outside, it looks like nothing is happening. Inside, everything is locking into place. That's what this range represents. A foundation being set quietly, deliberately, while most of the market looks away. Demand is no longer optional here. Someone has to buy, and as long as that remains true, every weak hand that exits only makes what comes next more inevitable. At this stage, the first instinct is always to point the finger at the banks. People assume this must be short covering, some quiet cleanup by bullion desks trying to get out before the next leg higher. That explanation feels comforting because it's familiar, but when you line up the evidence, it collapses under its own weight. Start with timing. Bank activity has a rhythm. They cluster trades around known moments fixes, opens, closes, moments of maximum liquidity where large orders can be hidden inside noise. What's happening in silver doesn't respect any of that. The buying is continuous. It shows up in the Asian session, rolls straight through Europe, and is still there in UCI US pre-market. No urgency, no bursts of panic, just a steady mechanical presence. As if a machine was told to keep buying until the job is done. That's not how a nervous short covers. That's how someone accumulates with a mandate. Then look at the physical market, because paper always leaves fingerprints there. If this were just futures being closed out, physical premiums should compress, metal would stay put while paper contracts shuffle hands. Instead, the opposite is happening. Premiums are rising, especially in Shanghai and in the UEA wholesale market. That only happens when real metal is being demanded and pulled forward. Bars are leaving the system. Inventory is being drained, not rolled. Banks don't do that. They prefer paper because paper can be rehypothecated. This buyer wants the thing itself. The final clue is correlation, and this is where the story turns. Silver is quietly detaching from gold. It's no longer trading like a monetary hedge or a fear asset. At the same time, it's starting to move in rhythm with copper, uranium, and assets tied to electrification and artificial intelligence. That shift doesn't happen by accident. Markets reprice assets based on who the marginal buyer is. When silver starts behaving like an industrial input instead of a safe haven, it tells you exactly who's stepping in. Piece those three signals together and the conclusion becomes unavoidable. This isn't retail, they don't have the capital or the discipline. It isn't hedge funds, they don't buy like this. And they don't want delivery. And it isn't banks sell into strength and manage risk. They don't defend floors across every time zone while physical supply tightens. This buyer isn't trying to make money on price movement. They're trying to remove a problem from the future. That's the twist. The silver market isn't being traded right now. It's being harvested. Someone has looked down the road, seen a bottleneck forming, and decided to solve it the only way that matters by owning the material before everyone else realizes it's gone. The real shift in this story isn't about identity anymore. By now, the buyer's shape is becoming visible. What matters is motive, because silver isn't being accumulated out of fear, or inflation, or some abstract hedge against the system. It's being accumulated because the digital world just slammed into a physical wall. Artificial intelligence doesn't live in the cloud. That's marketing language. In reality, it lives in data centers, massive concrete fortresses packed with servers that run non-stop, drawing power every second of every day. And the energy math behind that reality is brutal. A normal Google search barely sips electricity, around 0.3 watt-hours. An AI query like ChatGPT consumes roughly 3 to 10 watt-hours, 10 to 30 times more, and that's before models scale further. As these systems move toward artificial general intelligence, the curve doesn't rise smoothly. It bends upward. Hard. The existing power grid can't handle that kind of load. It wasn't designed for it. It's old, fragile, already stretched, and big tech knows it. That's why their response hasn't been to slow down AI. It's been to build around the grid entirely. Private power, private transmission, private generation, data centers paired directly with energy infrastructure, cut loose from the public system like lifeboats launched from a sinking ship. That's where the timeline tightens. In late 2024, BlackRock and Microsoft announced a $30 billion AI infrastructure fund. The wording mattered. It wasn't just servers. It was data centers and the energy required to run them. Power wasn't an afterthought, it was the core constraint. And when you line that number up against the silver market, the imbalance becomes impossible to ignore. The entire annual global silver mine supply is worth roughly $25 billion. One fund alone can outspend the entire industry for a year if it needs to. And it doesn't stop there. Across Microsoft, Google, Amazon, Meta, and others, more than $100 billion has been earmarked specifically for power buildouts. But those dollars come with handcuffs, net zero mandates, public commitments, political reality, coal is off the table, natural gas is radioactive, nuclear is clean, but it takes a decade. That leaves only one energy source that can be deployed at scale, fast enough and clean enough to meet the moment. Solar, and solar at high efficiency, runs on silver. This is the hidden mechanism snapping into focus. AI creates exponential energy demand, net zero policies restrict energy options. Solar becomes the only viable solution, silver becomes the bottleneck. Once that chain is understood, the behavior in the silver market stops being mysterious. The iceberg orders, the flat price, the relentless buying. This isn't a trade reacting to headlines. It's a supply chain being secured under pressure. In real time, silver isn't being bought because it's cheap. It's being bought because it's necessary. And necessity doesn't negotiate with price. What we're looking at now fits a very specific stage in every real commodity supercycle. And it's the one almost nobody recognizes while it's happening. This is accumulation, not the loud, public kind, but the silent kind where ownership changes before scarcity shows up on the front page. The smartest players always move first, when the market still looks calm, when supply appears available, and when price hasn't been forced to tell the truth yet. History gives us a clean parallel. In the 1920s, Henry Ford didn't just build automobiles and hope the market would supply what he needed. He saw the bottlenecks before they formed, so he went upstream. He bought iron ore mines, coal fields, timberland, even rubber plantations in Brazil. He understood something most executives forgot: for the next 50 years, if you don't control the input, you don't control the future. Ford didn't speculate on resources. He removed risk by owning them outright. For decades after that, corporations convinced themselves they no longer needed to think this way. Globalization and just-in-time delivery made resources feel infinite. If you needed something, you ordered it. If supply tightened, the market would fix it. That illusion died in 2020. Factories shut down, chips disappeared, supply chains snapped. CEOs learned in real time. What happens when you outsource survival? What we're seeing now is the consequence of that lesson. Vertical integration is back. Tesla refining its own lithium isn't a curiosity, it's a blueprint. Automakers investing directly in mines isn't optional anymore, it's defensive. And tech giants quietly accumulating silver off-market is the same instinct, scaled to a different battlefield. This isn't about trading inventory. It's about removing uncertainty. The silver being bought right now isn't heading to COMEX warehouses. It isn't being leased back into the system. It's moving into private vaults controlled by entities that don't need liquidity and don't answer to market optics. Once it's there, it's gone. Not delayed, not recycled, gone. That's what makes it dark inventory. The market can't see it, can't count it, and can't rely on it showing up when things get tight. And this is where the escalation becomes unavoidable. As long as the whale is still feeding, the price stays pinned, the bid stays firm, the illusion of balance remains. But the moment that accumulation ends, the moment the strategic buyer is satisfied, the support vanishes, not slowly, instantly. The floor that held everything together was never natural supply and demand. It was intentional absorption. When that intention is fulfilled, the market is left standing over empty space. That's the stage we're in right now. The quiet part. The part that only makes sense in hindsight. And once it passes, there is no rewind. Silver isn't getting expensive in the way people usually mean it. This isn't a story about speculation running wild or investors losing their minds. It's something colder than that. Silver is becoming essential, and essentials don't care about sentiment. They don't respond to speeches, forecasts, or wishful thinking. They respond to necessity. Look at who needs this metal and why. In medicine, silver isn't optional. It's embedded in antimicrobial coatings, catheters, surgical tools, places where failure means infection, and infection means death. Hospitals can't swap it out for something cheaper when prices rise. There is no alternative meeting the same standard. In the military, the dependency is even more unforgiving. Missiles, guidance systems, high reliability batteries, these systems don't run on copper and hope, they run on silver because it conducts better, lasts longer, and fails less. When national security is on the line, price sensitivity disappears. And now add AI to that list. Artificial intelligence doesn't just compete for capital or talent, it competes for electrons. It consumes electricity at a scale the system was never designed to deliver, and silver sits at the center of that energy chain. Transmission, efficiency, solar generation, the metal is baked into the infrastructure. None of these sectors can pause. None of them can wait for prices to come down. None of them can opt out without breaking something critical. That's where the escalation becomes unavoidable. When technology absorbs the available float, everyone else is forced into the same corner. Either pay more or go without. This isn't inflation in the textbook sense. It's not about currency debasement or policy mistakes. It's about physical limits asserting themselves, finite supply meeting non-negotiable demand. We're trying to build a science fiction future AI everywhere, clean energy everywhere, always on digital intelligence using a mining system that barely changed from a century ago. The throughput doesn't match the ambition. The inputs don't scale the way the outputs are being asked to. And when that mismatch becomes too large to ignore, the market doesn't debate it, it resolves it. Price is how reality enforces math. When supply can't expand fast enough and demand refuses to back down, price doesn't drift higher politely. It jumps, not to punish, not to reward, but to ration. That's the mechanism hiding beneath all of this. Silver isn't being revalued because people want it more. It's being revalued because the world has quietly decided it cannot function without it. You don't fight a whale. You never outrun it, you never outmuscle it, and you never win by standing in its way. You survive by understanding where it's going and letting it pull you through the water. That's what drafting is. You let the biggest force in the market do the hard work while you stay in its slipstream, protected from the chaos that crushes everyone else. As long as silver sits flat and volume keeps roaring, the work isn't finished, accumulation is still happening. The boredom you feel isn't a coincidence, it's the mechanism. Flat price is designed to exhaust attention, to make weak hands doubt themselves, to shake metal loose without raising alarms. That's when ownership quietly changes. That's when the future gets decided. The moment volume fades and price starts to lift, the story changes instantly. That's the signal that the iceberg is gone. The buyer is full. And when that support disappears, silver won't grind higher step by step. It won't give polite entries or second chances. It will jump, because the floor that held it down was never natural. It was intentional. This was never about predicting candles or timing headlines. It was about understanding necessity, about recognizing who needs the metal and why they cannot stop buying. No matter the price, no matter the noise, when you see that clearly, patience stops feeling passive. It becomes positioning. So hold the line, watch the volume, not the emotions, respect the silence, because that's where the real decisions are being made. In markets, just like in history, the quiet moments are always the most dangerous and the most profitable for those who know what they're watching.